Welcome, everyone. Today, we're going to talk about one of the most important topics that come across our Keyspire community, which is financing for real estate investors. I've got one of our Keyspire community sponsors on the call today and an expert, been in the banking business on the lending side for over 25 years. He understands the cycles as they come and go. He understands how the economy is going to impact you as a real estate investor trying to get investing. Harris Newman is here with us today from the Mortgage Group. I've known Harris for 7 or maybe 8 years now, and we've had a lot of great conversations about real estate and financing. And he really focuses us on the lending side and how all of that works. And so, really excited to dig into today's topic. Our conversation today is really built towards homeowners that make over $100,000 a year, $25,000 or more in equity or available cash, and looking to buy their first, second, or third income property, but just really struggling on how to qualify for financing. And we want to get into the details of what are some strategies and tactics that you can use in order to qualify for financing. Now, if you don't fall within that group, that's fine. You're still going to be able to learn and use these strategies and tactics. And really, what I would say is, if you have this core problem, then you are at the right place right now. And here's the core problem that a lot of our community or members are telling us that they're struggling with in financing is finding a great income property. The numbers work and it's in the right market and they've gone through all the due diligence. They go to qualify for financing and they just can't get qualified for conventional financing. So they need help with the tactics and the strategies to make that happen. And so that's why we're here today. We're going to talk about the 3 factors that influence an investor's ability to qualify for financing. Those are down payment, credit score, and income verification or income and expense qualification. We want to talk about the best timeline when you're purchasing an income property. So what order do things have to happen to give you the best possible chance? There's some huge financing issues and problems that I want to address today. Like if you're self-employed, what does that mean for qualifying for financing? You don't have enough down payment or the income and expense ratio is just not there. You don't have enough credit. What are the strategies and tactics you can use? Are there any family programs? What is a gift letter or a gift credit? I want to talk about the massive changes that came down the pipe just in the last couple of weeks for the MLI Select Program that every investor needs to know. And I want to get into, sometimes it could get a little controversial, but how the current economy could impact investor behavior when it comes to financing. So in Canada, we've got some political uncertainty happening right now. And we've got some uncertainty in Canada with our relationship with the US. I call them the three T's, the tariffs, trade, and Trump. How do these things impact us as Canadians when we are looking at financing our next income property? So that's what I want to talk about today. I've got Harris here to help us and demystify, provide some clarity around some of these financing things. Harris, thanks for being here. Welcome to today.
Thanks for having me, Michael. This is very exciting. Kind of feels like old home week coming back to the Keyspire community and all the members.
Yeah.
Awesome.
It's been great. I mean, we've got to connect at all the different summits and known each other for many years. So it's great to be able to have you on to add value to the community. And as a Keyspire community sponsor, you do a lot of things with the mortgage group in our community. So I want to thank you for that. But let's get into it. I want to start high level. What are some of the challenges and what does the landscape look like out there right now for real estate investors that want to go buy an income property? What does it look like for that person?
It's an interesting question, right? And it's a big question because I think what we're finding right now is clients are finding the environment very competitive again. So all of a sudden, there's not a lot of product out there necessarily. So everyone's competing for those same products. And so what we're finding is really the keys are really getting started from the beginning and being ready to go when you do find that property. You run the numbers, the cash flow makes sense. You've got down payment perhaps assembled, maybe you don't. I've had clients before in the Keyspire community that they get super excited, super jazzed. They find the property, they go put the offer in, and then we sit down and say, okay, so now let's talk about the pre-approval. Oh, we should have done a pre-approval? We haven't done that yet.
Yeah.
Or you know what? We need down payment of $100,000. We don't have that quite yet. So I think those are the things, those are the tools we need to think about that you've got assembled before you really hit that ground running so that we've got that all put together. It's almost putting the cart before the horse, right? So You're excited. You come out of the actual the masterminds, and you come out of all the different components of what you're learning in Keyspire, and you want to put those tools into play, and then it's really getting going. So if we take a step back on a couple of components, one, have we had a conversation regarding a pre-approval? And so those are key conversations. Typically, we'll sit down for 45 minutes on the first session, kind of go through understanding what's the landscape? What are you looking to do? What's the vision board look like? So what are those things you want to buy? Where are we buying in the country? So again, because prices will differ if you're buying in, New Brunswick or you're buying in BC or Ontario. So what does that mean in the way of down payment we need to assemble? So we'll walk through all of that as part of an exploratory conversation to really sort of set that tone, and then follow it through with sort of the next steps that one needs to go through from a pre-approval perspective. The other key thing we would kind of uncover in there as well is really the down payment. So, where's the down payment coming from? Is it coming from you've got it, or you need to get equity out of a property? So typically we'll find that clients are going to refinance properties right now. So maybe they've got the principal residence, they've got a lot of equity in there. They've been always educated, pay off your mortgage, pay off your mortgage, pay off your mortgage. And so all of a sudden that equity you've got in the property now becomes a tool that you can pull on and actually utilize, because we can draw equity out of that property through a mortgage or through a line of credit, to allow you to have the down payment availability when you do find that property. So those are a couple of key items to start. I'll pause there.
Okay, so no, that's a good first, a good opening for anyone who's looking to buy an income property. You're going to likely need financing, conventional financing. This would be from a conventional lender, not private lending. But the message I'm hearing is have that conversation before you find and qualify the property. Make sure that you have your financing set up.
And the realtors want you to have that pre-approval too. So as you're working with your realtors, they're going to first question they're going to ask, have you been pre-approved by your mortgage broker or your lender, right? So they're going to want to know what's the range they're working in. Like, is it 800,000? Is it a million? Is it 600? Like, what's, again, before they're running around taking out to 10 different properties, are we even in the right zone of what one can afford? Sorry for cutting you off there. Apologies.
Okay. Yeah, no, this is great, especially anyone who's never been through this before. So somebody would talk to you and you would qualify them based on those three things we're going to get into: down payment, credit, and income and expense ratios. And you're going to give them like a number, like a budget, like based on your numbers, Michael. I come to you, Harris, to say, based on your numbers, Michael, you can qualify for, let's say $600,000. Now I have a baseline to go out there, right? Now I know what I'm shopping for. I've got, what we call a budget. I got to buy a property that's 600,000 or less. Is that how it usually plays out?
Yeah, exactly. And so that's the key conversation as we go through that pre-approval process. And again, just to be clear, most banks at this stage are not really doing pre-approvals. They don't have the time to do the pre-approvals. So you're really reliant on someone that's been in the business or knows how to run the numbers to understand what one's going to qualify for. So we should be able to mirror that application once we're finished our conversation to go to a lender. And in theory, assuming I haven't missed anything in the mark, then we should be able to say, yeah, this is a no-brainer. We should be able to qualify for the 600,000 or the 700 or the 800. A lot will also depend on, every property is going to be different. We can map 10 different properties. What's the rental income going to be on that property? What are the taxes going to be on that property? Are there condo fees on that property? That 600,000 number we talked about earlier could move, the levers could move on that, because if you've got condo fees, well, now we got to factor in $400 a month or $800 a month, and that could take your 600 grand purchase price down. Are you buying a house, right? So those are all important factors to consider in the equation, and especially what is the rental income going to be on a duplex, triplex, fourplex, because those rental income numbers are going to change on every property we look at, from what you're going to generate for every unit. You may have great ideas about how you want to get the rents up, but the bank is only going to look at that based on what the rents are today. That is a key feature that people need to understand, is that they're not assessing it based on future rents. They're assessing it based on on a triplex, the three rents that one is generating today. And that's what you're qualifying on.
Okay. I think that's an important point that probably solves half of people's problems, because they're going to come to you if they don't go through this process ahead of time. They'll come to you, they say, Harris, I found a great property. It's $800,000. So I need to get, 80% loan to value, whatever we're going to do. I need to, and you're like, oh, well, if we do the pre-approval now, we find out that you actually don't qualify for that. We should have done that before, so you know what to look for. So part of the challenge of getting financing is not understanding how much you get financing for. And this is a really important point, Harris. And I think this is where I always start when I'm coaching. When I'm coaching people, I say it's not that you can't get financing. You can't get financing for the amount you're asking for, but you can get financing for something. Maybe it's only 400,000, right? Maybe it's only 300,000. And so the idea is to find out what you can get financing for. And I'll give you the story of when Scott and I were starting. First house we bought was in the $160,000 range, and I couldn't get financing for $160,000. This was in the year 2000. It was 5% down. And so, the mortgage was going to be for, say, 150,000, but I didn't qualify for that. But guess what I did qualify for? 75,000. And guess what Scott qualified for? 75,000. So together we qualified for the 150. And so I think it's a great opening point for this conversation and discussion is don't be discouraged if you're told you can't qualify for the amount you're asking. Find out what amount you can qualify for and go forward from there.
And I think we can take that even to the next level, Michael, because essentially when we hear we can't qualify, we may not be able to qualify, I'll call it inside A lending, i.e. your TD Bank, your Scotia Bank, your household names you see on every street corner. There are also monoline lenders that are out there. So something First National and CMLS and RFA, different lenders that are out there in monoline. But more importantly than that, we also have something called alternative lenders. So it's not private lending, but it is alternative lending, i.e. B lending. And I think the members need to understand there are other opportunities we can exhaust because the ratios can be extended. And so they might be able to push themselves into that 800,000 range through an alternative lender that they may not qualify at an A lender. So because the ratios can get extended than the typical box the banks look at, then essentially an alternative lender, they'll stretch the ratios that we would normally qualify one for between, contract rate and qualifying rate and stress testing, et cetera. So it's a very big component. I think clients and members need to be aware of the fact that there is definitely other lenders out there. It just may not be a traditional A lender that they would normally walk into their bank and talk to.
Got it. And this is probably the main advantage. One of the main advantages of working with a mortgage agent such as yourself is you can now assemble all of these different funding building blocks. We call them at Keyspire. You can assemble all these different options and say, what's the best funding source for your deal? Whereas if I walk into the front door of a bank, I only have available what that bank has available, but you have available not only what that bank has available, but what all these other lenders. And so I think that also circles back to the pre-qualification question saying, let's get pre-qualified. Let's have the conversation with our mortgage agent to really understand the situation and to understand, okay, if you need more than 600, we can get it, but it's at different terms. We can get you to 700. Great. Great.
Sure.
What were the three again?
Sorry.
If you could just recap those three. We've got, was it traditional banks, monoline
lenders, and then alternative lenders. So essentially, there's your traditional A lending banks that you see on every street corner, and then there's monoline lenders. Some lenders that wouldn't be household names necessarily that we still have access to, but again, most of them still play in that A space, that A lending space. But some of those monoline lenders also have alternative lender access, so B lenders, and so those would be the three streams we would look at to figure out where we can qualify somebody. So if you're really excited about getting that $800,000 home and you can only qualify at 6 or 650 on an A lender, not to say we can go to 800 necessarily on a B lender, but it might be able to stretch that purchasing power beyond what you would be able to do inside a traditional A lender.
So it sounds like it'd be pretty tricky if an investor tried to do all this on their own, like try to assess how much money can I borrow, what lenders should I go to. And that's part of like having a quarterback on your financing team, like a mortgage agent, because a lot of people ask, like, why would I go? People ask, why would I go to a mortgage agent? Why don't I just go to my bank? Because that's where my credit card is, or that's where my bank account is. And so, I think we've answered that. When you go to a mortgage agent, they can now be that first point of contact of a quarterback, get you that budget, and now you take that and go work with your realtor. That sounds right.
Because if you go to your traditional bank, they're only going to talk about their particular product, right? Which may not have alternative options available. So they're going to talk about 3-year fixed, 5-year, all that good stuff. But beyond that point, it's going to be really beyond like what else is out there that you may not know. And so the mortgage agent you're dealing with would be able to sort of look across that landscape, 50 different lenders as an example, right? So versus walking to a TD Bank or a Scotia Bank or a BMO. You'd
Yeah.
have much more access and depth in dealing with a mortgage agent. And we're pulling the credit bureau once,
Mm.
we're pulling it 15
Hmm.
times, right? So that's another,
Hmm.
talk about credit bureau scores coming up. That is important. It's a once and done credit bureau pull versus you're going from Scotiabank to TD Bank to BMO and you got 3 credit bureau pulls. That's going to have impacts on your scoring.
That sounds not good in terms of, yeah, we're going to get to
It can
credit,
have an
yeah, in
impact,
a
negative.
moment. Okay, let's get into the big three. But I think people are thinking, what does it cost to have you do something like that? That pre-qualification, like, is it a couple $1,000s? Somebody to hire you to do the pre-qualification? Because that sounds pretty in depth and specialized. What does it cost to have to go to you and have you do that pre-qualification to tell me how much money I can spend?
You can spend nothing. I will take care of the pre-approval for free. How's that? Yeah,
So that's part of like the
I don't
service.
charge
Okay.
for pre-approvals. Essentially, I'm working with investor type based clients that we deal with day in and day out at Keyspire. And part of the process that I do, or what you're benefiting from, is that 25-year experience of being in the lending
Hmm.
space. I used to be the guy that ran the credit adjudication center for one of the big banks, right? So we
Yeah.
had 125 analysts that underwrote all the credit for the bank.
Mm.
And so we know exactly what the polls are going to be on what you need to figure out when you're starting with a blank piece of paper. And so no, there's not a charge to do a pre-approval with me from that perspective. That's one of the services we offer as part of the process with our Keyspire community.
Okay.
If we're
Awesome.
going to go
Thank you.
alternative lending, there are some fees
Yes.
and different things. If we get to alternative lending space, then I'm not gonna say there's not fees at that point.
Yeah.
It's
Yeah.
not a today issue. That is something that would happen at day of funding. So there will be fees that are involved with an alternative lender that you wouldn't see traditionally with an A lender.
Yeah.
Rates will be slightly higher on the alternative lending space than they would be in the A lending space. But that's one of the benefits of being able to go and stretch the purchasing power. Um,
Yeah.
there's some trade-offs in there, right? When again, as long as you factor in those numbers into when you're running your cash flow analysis and your 4 ways to win, and the numbers still work with fees and different components and higher rates, then if the numbers still work, then that still works.
Okay, good, good. So let's get into the big three, the income and expense ratio, the down payment, and then the credit. What I want to discuss is what are the challenges that you see people have with these, and what are some strategies that people don't know about that they can use to get over the challenges? So we'll start with income and expense. For example, is when you're qualifying somebody, and you alluded to it a number of times, a big deal is how much money you make and how much money you spend, right? And then you come up with something, is it called a debt service ratio that you
Two of
come
them.
up with? There's
Yeah.
two different ratios. So just a quick education for those who don't know about, like, when I come to you, you're going to need to look at income and expenses, come up with two ratios. And then I want to know, well, what is the biggest problem people have with these ratios?
Great question. So, essentially, when we're going through a pre-qualification for whether it's through a bank or through a different lender, whatever the case is, we do an application. And essentially, when you send the application into my team, we will go through and analyze what is the income. So let's assume you're earning $100,000 for argument's sake, right? So you got an income of 100,000, that's great. What other expenses do we have? So again, we're not talking about necessarily like Roger's cell phone bills. We're talking about like what credit cards do you have? What unsecured line of credits do you have? What car loans or car leases do you have? Those are real expenses that need to be factored into the equation when we're calculating the ratios, and that has an impact on the overall borrowing ability. So the two ratios you refer to, one is called a gross debt service ratio, and that ratio is essentially based on your housing costs. What's your mortgage payment, your property taxes, your condo fees, your heating. Those are the four main pillars that kind of calculate that ratio into what they call a gross debt ratio. The secondary ratio that they look at is then the total debt service ratio, which is everything we just talked about in the gross debt section, plus all the ancillary items that we talked about with unsecured credit lines of credits, credit cards, car leases, car loans. All that gets factored into the secondary ratio. Those two ratios, depending on the lender, will have goalposts that they've got to fall within.
So
And
then, Harris, just to recap, the gross component it tells me how much of my total income I'm spending on my
correct.
housing, right? Overall, you'll get a ratio. The second one is how much of my total income I'm spending on all my expenses. So it's important.
Housing and other stuff. Yes.
Housing plus everything else. Okay, so that's what we're measuring, is how much of a person's income they're spending to live and run their house, and then to do everything else. Okay, continue. So we got two numbers. that you're going to ask. And, I tell people, please don't lie on these numbers when you go to your mortgage agent, because the numbers are going to come out when you go to the bank. They're doing the
When we
best
pull the
thing for
credit
you,
bureau, we're going to see the
right?
numbers anyway. So
I've heard stories of people not including, like, oh, let's not include my credit card payment so it looks better. Remember, this is a pre-approval. This is your budget to go out there and to buy income properties. If you don't have the right number because you didn't include something, then you're just doing yourself. It's like cheating at your golf game. So you're only hurting yourself. Continue.
So those, and then the third measurement is really the loan to value. So that's the other key component as well, is what's the loan to value. So again, you're buying, simple math, you're buying for $1 million, you're putting $200,000 down, and essentially you're financing $800,000. And so to qualify for the 800,000 mortgage, there's then components that we have to do called stress test. Stress test has evolved. So if you think back 4 or 5 years ago, pre-COVID, stress test was being calculated at 5.25%. Rates were down at 2% and 3%, nice and low back in the day, maybe even less than 2% back in 2020, right? Fast forward to today's environment right now, the governing bodies for the banks have now said 5.25 doesn't work anymore, because in some cases rates are higher than that now. And so we now need to do the contract rate, and the contract rate essentially is, I'm making up numbers. You're taking a 3-year term at 4.75, then we would qualify you at 6.75. It's the contract rate plus 2%.
Oh, wow. Okay.
So no longer 5.25 back in the day a few years ago. So now it's whatever term you're taking plus 2% of that rate.
Okay, this is a big deal. This is what our members are saying, where they're getting crushed. They're like, so this is called just so we get the language, this is called the stress test. And basically, the government regulation is saying that, and this is a federal government law
This is
regulation.
OSFI that manages that oversees all the banks. OSFI is the governing body that's put this.
Okay, governing body says that you have to qualify for 2% above what you're actually going to pay. Is that provincially? Does that change provincially to 2%, or is that across
National.
Canada? Okay. So that's an important for everyone. If you've heard the word stress test, that's what that means. It means if your mortgage is going to cost you 5%, you got to qualify at 7%. And so that is what people are really struggling with, is what the coaches tell me, is they're saying, coaches, we can qualify at 5%, but we got to qualify at 7%. It's just impossible to buy an $800,000 property. I need $250,000 of annual income, which I don't have. So let's stay here for a minute. Like, how do we can't break the law. We can't change the law overnight anyway. I mean, we talked about some political changes. If we move in Canada from a more liberal government to a more conservative government, we generally see less regulation. You see things like lower taxes, but you also see things like less government intervention and regulation. So that might impact this, whether it's positive or negative. I'll leave the viewer to judge. But that might impact this in terms of reducing the stress test. But as it is today, 2% over, what the heck do people do, Harris? If I can qualify at 5%, if I need 300 grand to buy a $800,000 income property, I'm making that number up, by the way, because it depends on income and expenses. But how do I buy this income property without having the income, without breaking the law?
So again, it comes down to really a couple things. One, do we need to look at a potentially JV, a joint venture, right? So is this somewhere where I've got a client, Keyspire clients I'm working with right now. They are buying a property out of province. It's a brother and a cousin that have kind of pulled themselves together on this, and now we've got their wives. So we've got 4 people really qualifying from an income standpoint.
Okay.
Particular property that they're buying they're buying a fourplex. So again, we've pulled incomes together, we've pulled down payments together, and so from that perspective, they're able to get qualified for that particular property when we brought them all together. So they're doing this as a joint venture together, and so we're seeing more of that happening now, where you've got JVs happening. Sometimes JVs happen behind the scenes, and sometimes JVs happen up front, right? So I've got other clients where they didn't need them to qualify for the mortgage. They had enough income to support it. However, there's a JV partner behind the scenes that's giving some of the down payment to them, right? So now working together. And so we're not going to focus on Susie and Joey that's behind the scenes. We're going to focus on, Mabel and Bob that we're dealing with up front, because those are the only 2 people that we need to worry about qualifying for. But you are finding where groups are coming together and pulling resources. Sometimes they're on the application, sometimes they're not on the application.
Got it. Okay, I want to dig into this, and I just want to, underscore that we often think in the open marketplace, everyone out there thinks JV works like this. One partner brings the money, one partner brings the does the work. Like one brings the down payment, one does the work. They come together to do a successful deal, and that's certainly possible. But you bring up a good point that people need to understand is that a JV is not necessarily one person does the money and one person does the work. It could be one person brings half of the qualifying power and the other person brings the other half of the qualifying power, and they could both bring half a down payment, or one brings more of a down payment than the other. But we're focusing on how to qualify as our issue right now in this conversation. And so, this is really familiar to what I said Scott and I did. We both had half the down payment, and we had to combine resources for that, but we only both had half the qualifying power. So that's one method that we can. If you can't qualify for property on your own, you can always find somebody that can also qualify and come together. Now, how does that work in terms of the writing the deal? Like, are they both on title together, or if you and I were doing this, Harrison, can I be on title only me, or should we both be on 50-50? I don't, give us a little bit of the mechanics so people can picture themselves doing this.
Yeah, yeah, for sure. And so again, every situation can be different. Again, nothing's black and white in lending. I will tell you, everything's kind of gray.
Mm.
And as we go through those preliminary conversations, early days, we'll have a better understanding of kind of how do we put this vision together. But in this particular case that we're talking about right now, there will be 4 of them on title for this particular property. So they're all accountable that if, God forbid, 1 or 2 of them stop paying, a husband and wife on one side stops paying, then the other husband and wife on the other side is still accountable for those mortgage payments. The bank will have a conversation, come knocking, saying, "Hey,
Yeah,
Susie and Joey didn't pay, but Billy and Bob, you're on the hook for it," right? So absolutely, typically that's what happened. Again, when we get into multifamily and different components and commercial, there's even more conversation on how well
yeah, it's different.
that'll for a moment. But yes, on a traditional duplex, triplex, fourplex that someone's buying as the investment property, uh,
Mm-hmm.
another way to think about also is what if they're going to buy it and they're going to move into it, right? So we're starting to see now where clients are paying rents right now and high rents, and so they're going, why am I paying $5,000 a month in rent? Why not go buy a triplex and move into it so I can bring my rent cost down, because that's going to be factored into that one of those ratios we talked about before. And by the way, I can have now 2 other tenants now paying for part of my mortgage. Like those are the creative strategies we're starting to work with our clients a bit more on. And I had this conversation yesterday with another Keyspire client who's currently renting in the GTA and now thinking
Yeah,
about opportunity now where she's looking at possibly now buying a triplex where they will move into one of the 3 units and they will now rent out the other 2 units to help bring their costs down to allow them to now buy more, because it's all about how do we continue to grow that real estate portfolio. And that's what they're starting to think about. Where can they trim some costs down and help offset the cost with rental income while getting them ready now to go acquire the next property, whether it's a triplex, a fourplex, a multifamily. So we're starting
that's
to see a
great.
lot more of that. And then
That's
just
great. Yeah.
the other component also really comes down to is also we talked about earlier is, again, if we can't qualify in the A lending space, it's not to say we can't look at the alternative lenders. Because again, we might be able to stretch that purchase power a little bit further with the ability to qualify on different ratios. And that extended ratios makes a difference. And also the rental offsets. When we start talking about alternative lenders, they don't use the same traditional rental offsets that a big bank would look at. So again, just different tricks of the trade, and more reason back to your conversation earlier about working with a mortgage agent, because at least they'll have the landscape on sort of who's got more
Yeah.
favorable rental offsets, who's got more favorable, that looks at rental income differently than perhaps the other one. What if you're buying a property and there's going to be a unit or 2 vacant? Like, how does that? Will the bank allow us to use market rent analysis from the appraisal?
Yeah.
There's
Yeah.
so many nuggets out there, right?
Yeah, yeah. You remind me of a story of when I was an early investor, and I'm taking notes here because this is amazing. I want to dig into this. I remember when I was an early investor, Harris, I was specializing in student rentals. Scott and I both specialized for our first five years in safe, affordable student rentals, and we had that whole market. We were the guys in that market. But I remember that somebody came to me. I was at a networking event. They're like, "You do student rentals, Michael? you can't get financing on student rentals anymore. They don't do it. I'm like, what do you mean? They're like, I've been to all three banks in my plaza and by my house, and they all told me that you cannot get financing on student rentals. I said, okay, then how did I just buy two student rentals last month and I got financing? They're like, I don't know. Did you break the law? What did you do? I said, those banks don't do financing on student rentals. It doesn't mean nobody does financing. It doesn't mean financing on student rentals is illegal. Somebody does it. You're just going to the wrong person. And so I said, here's a number to my mortgage agent. Go to them. They have access to over 200 lenders. I don't know what the number is, but at that time it was over 200 lenders. I said, I will promise you, out of those 200, one of those lenders at least will provide financing for student rentals. And I saw them a few months later. It was a networking event with the city council, and they came back to me and they said, I got the property. You're absolutely right. And I think this is a really important point. And I talk about this with financing a lot, Harrison. You just talked about it. It's not only student rental policy, it's your income, your rental offsets, your extended ratios, maybe your down payment. All of those things are set at the policy level of the lender. And just everyone's got to be aware of the policy set at the government law level, right? Like you probably won't find an alternative lender that's willing to break the 2% stress test rule, right? You're not going to find that, but you're going to find an alternate lender that's going to say, you know what, you got 15% down, we can do that, right? Or you've got, a different income expense ratio. So I wanted to share that story because it's a perfect example of people out there in the marketplace today that they don't have the education, they don't have the team or the right mortgage agent or a mortgage agent at all. And they say, Michael, it's impossible. You can't get financing today. And this conversation is going to help those people dramatically.
Absolutely.
So yeah, thank you. Thank you for that. So I want to just recap. If you're watching this and you cannot qualify for financing, either because the stress test is killing you or you just don't have enough income to your GDR, gross debt service, GDS,
gross debt
your
service
GDS and TDS.
TDSR.
Your GDS and TDS aren't correct. Already know you're going to go to a mortgage agent first, and your GDS and TDS aren't quite there. Harris has given us 3 strategies that he uses right now with his clients. It sounds like a lot of them are even Keyspire members because you've added a ton of value to our community. You can JV with someone to qualify, just like Scott and I did when we started. You can buy a multi-unit and move in, just like Scott and I did when we started. And you can capital stack with other forms of lending, not just the conventional lending, but you can use the monoline lenders and the alternative lenders to have more favorable things like your extended rates and your rental offset. So I think if you're leaving with just these three strategies today, people are leaving with a ton of value because this is really important. These 3 strategies. These are 3. Is there anything else, Harris? And then I think I want to learn a little bit more because this is super interesting.
Credit bureau,
is there
you want
anything
to
else?
chat about too. The credit bureaus, I think you brought up earlier too, the scoring and stuff like that. So just very quickly, again,
Okay,
on the way to the
we
office.
just that was income. Now let's talk about credit. So you just showed us how you can qualify if you don't have enough income. Now let's talk about how you can qualify if you don't have the right credit.
Okay. We will come back and talk about one more thing. I think we should is about self-employed people when we talk about income qualifying as well. But let's pause on that for a moment. We'll pause that question for a second. But on credit bureau scores is a good example. Like I was on the way to the office this morning and a client reached out to me and they said, "Hey, I'm looking at buying a car in the next few weeks, but I also want to buy a property." And so it's the holy cow factor. The PG rated version. It's like, yeah, not a great time to be buying a car at the moment because we're going to have another debt we now need to factor into the equation. So again, important to think about when you're going to apply for a new credit card or a new line of credit or a new vehicle. Try and keep those away from when you're about to start applying for credit to go buy a property because you could have credit bureau hits to the bureau, might have 2 or 3, which can and will have an impact on the scores. And again, banks will look at scoring. Again, everyone's got their own measurements on what is the appropriate minimum beacon score that someone is looking at. And again, tips for you guys, for those who are looking at either Borrowell.com or Credit Karma, those are opportunities as you know, Keyspire members, you can go in and sort of understand a bit more. And if you're with some of the banks, even they offer sort of TransUnion type scoring systems that are built into perhaps lenders you're dealing with. Just to understand, it's important to understand the power of your score because, you know, if you're below a 680 threshold or you're below a 720 threshold, different numbers that will have an impact, especially it could have an impact on pricing. So you may say, hey, what's my rate? Because everyone always says, what's my best rate you can go? Great question. Really premature because we need to understand what your score is going to be because that's going to drive the rates as part of the equation as well as your ratios. But that credit bureau score could have an impact on potentially what your actual interest rate might be depending on where it falls.
Got it. So the message is apply for credit after you buy the property. And you probably have seen, yeah, this is like a horror story for you. You're like, no, what did you do? So timelines, we talked about timelines and language. If somebody gets pre-qualified, that's not good enough because you're getting pre-qualified based on you didn't just apply for that credit, right? You've got to wait. It's not like you could get pre-qualified with Harris and then you're spending 30 to 60 days to find the property. In that 30 to 60 days, you get new credit. No, because when you go back to Harris and you say, okay, it's time to write the mortgage, he's going to say, what the hell is this? You didn't tell me this. This is new. So you've got to wait till it's the closing date on the property that we want to wait till, right? Where the lender
post-funding is
transfers.
usually better once it's been funded is typically a better time to be doing that.
Post-funding.
You're absolutely right. Because if you're going through the pre-approval process and all of a sudden, you know, 30 days in, you now have to go get that new vehicle, like that client sent me the note this morning going, well, sucks, it happens, but that could have now a knock-on effect on the amount you thought you could borrow, right? So, and again, if rates change, there's so many moving parts on things, right? So if rates change, that can have an impact on the amount you can borrow, right? So we're talking rate today on what it is, and all of a sudden rates changed a week from now, 2 weeks from now, and right now we're seeing some activity in the markets with lenders moving rates either up or down. And so, you know, that's why I'm saying it's a pre-approval until we actually submit the physical application to the lender, which then locks in the rate. That's really the moment where we've got that rate sort of guaranteed as to what's going to happen.
Okay, great. Okay, I have a couple last questions that our members are saying, please ask Harris. One, it has to do with, can you share with us any, I'm going to call them secret programs, and I don't want to make this over dramatic, but, you know, just programs. Are there any programs out there that investors need to know about that are going to be helpful for them to buy that income property, first, second, or third income property, or 10th income property? And by programs, I mean, are there any lenders out there that have some special programs that are that you go to all the time? And are there any government programs? Because the government programs change all the time. Sometimes there's free money from the government. Sometimes there's lower interest rate. So I would just want to know for our viewers, are there any programs at the lender level that we should know about, and any programs at the government level that people can take into account if they come see you to do the pre-qualification?
Yeah, there's programs out there, like some lenders will have a cashback program, right? So there might be an opportunity, hey, you can't use it for your down payment, but we can use it for your closing costs as an example. So there are sometimes, again, not all lenders have it, but some lenders will have a cashback program. Some lenders will have a purchase plus improvement program. So, hey, I'm buying a property. I need to put 50 grand into the property when I walk in there and renovate. They're time bound, so there are tight timelines to do all that in, but there are lenders out there that we deal with that do have a purchase plus improvement program above and beyond the amount you're trying to qualify for to buy the initial property. And by the way, I got to put a new some flooring in. I got to do some painting. I want to fix up the basement, stuff like that. So there are different lenders we have out there that have access to specialty programs like purchase plus improvements.
That one is my favorite. Purchase plus improvements. That program alone has done me so well in properties, because what we do at Harris is, you know what, Keyspire is, one of our core strategies is flip to yourself. You buy a property, you improve it, you add value, but instead of flipping it or selling it to someone else, you just flip it to yourself by refinancing it. So it is one of our core strategies that Scott and I started from day one. And the purchase plus improvement program, the lenders that offer that are highly valuable to us as real estate investors, because we want to be able to, and the difference of purchase plus improvement from what I see with most programs, Harris, is that we're going to pre-qualify for the higher amount, right? As opposed to, I'm buying it for 600, I'm going to refinance it for 800. You want to go in and say, well, let's make sure we qualify for 800 before you go do all of that work, so you don't have to run two processes, two qualifications, two credit scores. Is that generally how it works?
What they typically do on a purchase plus improvements is if you're buying it for 600,000, you're going to put $50,000 in work into the property. That's the way the deal is structured, not for the after repair value,
Okay.
which is where you're heading. I do have, so I've also had some clients from Keyspire reaching out recently on fix and flips, right? So that's another new one that's kind of coming back, not new, but it's coming back around again. And so we've just found a unique lender that does some stuff in Ontario and Alberta as an example, and where they have got a really great program. And again, I think it's not always about the rate. I think everyone's always caught up, oh my God, it's going to be like 6% or 10% or 12%. The question is, do the numbers work? Does the math work? Can this let me get into the market with 15% down, 20% down, whatever the number is?
Yeah.
I'm going to pay a higher rate. But if you run your Excel documents and all your different cash flow analysis and the numbers still work based on different components, then it's great. And so they'll actually look at, as an example, they'll look at the after repair value, to your point before, saying, okay, we're buying it for $1 million. We're going to put 200 grand into it, and it's going to be worth 1.45 million when it's all done. Like, that's what we're going to go list it for. So the clients have an opportunity to make a couple hundred grand or 100 grand in there once they paid for their expenses back. So that's another program
Okay.
that I've just uncovered recently. That's a nice new nugget for clients that are looking at doing fix and flips. There
Nice.
are CMHC type programs for insured. And again, that's typically with a client that's usually got less than 20% down payment. So again, that's a whole topic on its own. There's the insured business, which is less than 20% down, and then you're qualifying for with more than 20% down, the uninsured business. So if a client said, hey, I've only got like 15%, I'm going to move into that property and I want to go, eventually maybe rent out the basement, for example, right? It's a legal duplex. So there's opportunities. If you qualify, I will caution the ratios are tighter, right? So it's a CMHC government insured mortgage. So essentially the qualifications can be a little bit tighter. But yes, they've changed things now where it used to be 25-year amortizations was the max you could do in CMHC. Just recently changed to 30 years now. So that's good news. They've
That
just,
is good. Yeah.
just
Yeah.
increased the purchase price level, which was capped at $1 million previously. They've now changed that and it's now $1.5 million to understand that $1 million is not a lot to buy you depending on where you are in the country. So now there's been changes in the CMHC and Canada Guarantee and the different insurers that are out there right now. They moved it to $1.5 million. So there are programs like that we can look at. In addition,
Okay.
CMHC, MLI Select, which again, another big topic to tackle.
Okay, good. And if anyone watching, if you think this is all confusing, all good information but confusing, that's where that pre-qualification comes in. Having somebody like Harris that has the conversation and puts all of these pieces together. So you're not expected to know every single program out there. You're expected to work with the right person, the right who that knows every single program out there. So this is just intended to provide the information and open your eyes in terms of what's possible. But unless you've been in the banking industry for 25 years, you really need to work with that person that can put those pieces together for you. Now let's move on to the government program side of things. And these government programs are always changing. Like I remember it was in December 10th of 2024, the Canadian government released something called the Canada Secondary Suite Loan Program, where they'd offer $80,000 for you to put in a secondary suite. And that was doubled from, it was previously 40 and then up to $80,000 to put in a secondary suite. So people love free money from the government. They love these loan programs, even if it's just, a loan that they don't have to qualify for. Do you know of any government programs that are out today that an investor would find useful to combine with all these other strategies that we talked about?
Yeah, I'd say the biggest one that we're getting a lot of calls on right now is the CMHC, the MLI Select program. I'd say that seems to be sweeping the country as a top area of discussion. And so again, we'll try and keep it simple. CMHC MLI Select is an insured mortgage that allows you to acquire properties. Either up until recently, there's been changes in the last 2 weeks that have changed the entire landscape of the MLI program. So it's still out there, but it's now got different limitations to it. But there are three major components on how one qualifies for an MLI Select program. One is based on Accessibility. So, is there elevators in the property? Are there wider doorways? Can you actually take a wheelchair into a shower? Like different components from an accessibility standpoint. And we actually
Okay.
have to get a report completed. Part of the Rick Hansen report would have to be completed to qualify with accessibility. There is then something called energy efficient, which again, that a year and a half ago was the sweet spot. Everyone was doing energy efficient, changing windows, making everything more energy efficient in the property. And you're scoring points along the way in any one of these three components we're going to talk about. So accessibility scores you points, energy efficiency scores you points. But now that there's been changes that happened about the back half of 2024, they've made it more restrictive because everyone was sliding in under energy efficiency.
Yeah.
God love the government. There's always changes when they realize they got a bit of a loophole or a gap. They tighten
Yeah.
it, and there's no notification. Like it's just like today it's changing. And so sometimes something might get grandfathered and sometimes it may not get grandfathered in there. The third component that right now people are really qualifying on the MLI Select is under affordability. And so that is the other component that right now people are using as their way into this. Up until now, they're allowed to have, you could qualify for, depending if you qualify, for a 5% down payment and an amortization of up to 50 years. So that is the big win right now in that
Wow.
program.
Okay,
Five.
so that's the benefit for me to do this. I either have to spend more money for accessibility, I have to spend more money to be energy efficient, or I have to lower my rents to be affordable. That's what I have to provide. But what I get is in some cases up to five, as low as 5% down, because I'm sure it's a sliding scale like everything is, and up to how many years did you say amortization?
50.
50. Now, that might scare anyone watching. If you own your home and you've never bought an income property, that might scare the shit out of you. You might say, why would I want to take 50 years to pay this off? As real estate investors, it's the opposite philosophy as your primary residence. This is designed for cash flow. So if you can spread your payments, total payments out over 50 years versus 25 years, you've now made your payment in half, which means you've increased your cash flow. So, I always ask everyone, Harris, would you rather have a property paid off in 30 years free and clear and struggle for 30 years with no cash? Or would you rather have it paid off in 50 years or my strategy, never, and have cash every single day to run your lifestyle? And what I used to do, Harris, I just refinance every 5 years, go back up to the maximum amortization and understand that this investment provides cash flow. And if it goes up in value, it's simply a bonus. So 5% and 50, that's the benefit people get. Is there any benefit in terms of the actual interest rate, the cost of borrowing? Is that, yeah?
Yeah, the
So
cost of
what
funds
is
is
it?
typically linked more to the bank prime rate, and there's a premium added to that. So again, typically when you're doing commercial, your rates, so again, you can run all the numbers you wish to, but keep in mind on commercial, the rates are not typically set until the week of closing.
Mm,
So again, if you're doing this 4 months out, you may run your numbers at 6% hypothetically, and then by the time you get to closing day, if there's been a movement in the marketplace, it could be 6.5. So you always want to make sure you've got some conservative numbers in there because you got to make sure you got wiggle room when you're running your data points. That if the market should shift, then you've got that factored in. All of a sudden, you're not upside down potentially in there.
okay,
Yeah,
so
rates
the
would
interest
be
rate could be lower.
yeah, the rates are
Uh,
definitely more connected to the bank prime lending rate with a cost of funds on top of that. But essentially, it's typically more favorable than it would be on just your traditional residential type lending.
okay. Thank you. Harris, our time is up. Thank you for being here. Appreciate it. We're going to make sure that video gets out to as many people as possible so that they understand that next step. And again, I'm speaking to you watching. If you are looking to buy your next income property, that's what this is geared towards, not to buy your home or to buy a cottage. It's what's your next income property because that has its unique benefits and unique challenges. And so, Harris, just in closing thought, somebody's wants to take this information, buy their next income property, what's the first thing that they should do?
Call me.
There you go. Good
I
answer.
think right. I think honestly, right now, you look on what we would do is sit down and kind of go through that pre-approval. That is really the key focus. Is let's have that understanding conversation about what one is looking to do, and then we will work accordingly with you on really walking you through the next steps. It's hand holding, right? Again, you want to work. You talked about building your team. You talked about building your partnerships around you. like your realtor, like your mortgage broker, like your lawyer, like your accountant, you're assembling that team right now to have in your corner that you can pick up the phone and call any one of us. And one of us may have the options to be able to tell you, hey, who's a great lawyer, who's a great accountant. Like there's different people. We have a large network in the Keyspire community that we can tap into. But certainly, I think the first part is really getting started with the pre-approval. We didn't get a chance to talk about the self-employed clients, but that is another key target audience that we should do on another conversation when you got time on that.
Okay, well, let's do it. And if you are self-employed, you can have the one-on-one with Harris. He has an answer for you, which is excellent. If you are a Keyspire member, you're going to find Harris in our Keyspire Connect. You can see him there, watch his videos, learn more, and connect with him. If you're not in Keyspire Connect, then you have if you have the internet, you can get a hold of Harris. You just Google Harris Newman, the mortgage group, and you can get a hold of him and go through that pre-qualification process. Harris, thank you for being here. Appreciate it. Great to see you again.
My
It's
pleasure.
probably been about
Awesome.
6 months since we saw each other. So thanks for being here. And I think we should do this again. Let's do this again in like 4 or 6 months. Like you said, the market will change completely and the information will be different. And let's be out there to help everyone.
Absolutely. Looking forward to it. Thanks for your
Awesome.
time.
Thanks, Harris. Okay. Talk to you later.
Take care.